Welcome back, you legends, and just look at this sea of green. Today, all three major indices are up nearly 2%, the S&P, the Dow, and the NASDAQ. Let's take a look at the different sectors today. Leading was energy, basic materials, communication services, and cyclicals, largely led by this massive, humongous, ginormous sell-off in the dollar index, which was led by this. Look at this. The Bank of England steps in to calm markets. What are they doing? The bank will start buying government bonds at an urgent pace to help restore orderly market conditions after continued volatility meant material risk to the UK financial stability. Now, following this news, guys, the dollar index fell against the British pound, against the euro, as well as the Japanese yen. But now this is very interesting. What the UK government is doing, despite this rally of the euro and the sterling, is a currency negative policy. What they're doing, guys, is that they're printing money to buy these distressed assets, these bonds. So they're inflating the currency to suppress yields, and this never works. This never works. Japan tried to do that earlier this year to stabilize the yen, and the yen just collapsed. It lost nearly 40% just this year because of this policy. And so in the very short term, yes, this financial stability to the UK financial system will help stabilize the pound for maybe a few days, maybe a few weeks max. But as they continue to print money, this will only fuel more strength into the dollar and into US treasuries. So this is very bad news. In the very short term, this is what happened. We had this bear market, this dead cat bounce rally. But in the medium term, this means more fuel, adding more fuel to the fire of the dollar index. I am still fully anticipating the dollar index to hit 120 just to match the highs that we've seen back in 2002, 2001. I'm really waiting for the dollar to hit those same highs, 120. And on our journey there, the market will see a lot of bumps, especially the equities and the bond market, and it will only lead to more volatility, more selling in the stock market. Now let's take a look at the stock market map, and it looks bright green, really just like every bear market rally that we had this year, every dead cat bounce that we had this year. We had a very strong rally. We closed very close to the high of the day. This happened systematically this year, and in fact, just in this period, guys, I will point out 7 times where this exact behavior happened. It happened here, and then we had a sell-off. It happened here. We had a sell-off. It happened again here. We had a sell-off. It happened 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 here. We had a sell-off. In every one of these 7 examples, the stock market closed near the high of the day in every single one. And everybody thought, oh, rah, the bottom is in, let's buy. And this period of consolidation looks eerily similar to the period of consolidation or distribution, I should say, that we are in right now. And why do I say that? Look at this, guys. We systematically had rejections of the $430 level. We had it here, here, and on the third time, we had this precipitous sell-off right after the Fed meeting on May 4th. Now here, guys, we're seeing the exact same thing, right? We had a rejection of 370 here, we had it here, and then we had this close, one final close here. We got really close to closing near this 50 period moving average on the hourly chart, exactly where the last bear market rally failed. Is this a coincidence? I don't believe in coincidences. Look at this again, guys. Let's take a look at the daily chart again. Look at this. We closed exactly at the upper edge of this demand zone where we had this gap fill. The prior 3 days, we tried to fill this gap. We tried to close at the gap fill level. We failed. Today, we did it. And we closed exactly at the upper edge of this demand zone. Again, is this a coincidence? I don't think so. Now let's jump into the stock market map. I want to point out something very, very interesting. Look at this. Everything is green except for Apple. When was the last time you've seen that? I cannot remember the last time I've seen the entire market moving up except for Apple. And I did point this out in the trading community today. I thought this was very suspicious. And there's a very good reason Apple sold off. And what is it? Well, Apple ditches iPhone production increase after demand falters. Now, Apple is the biggest, most profitable, most cash flow rich company on the face of the planet. And when you see demand faltering for Apple, really the most defensive of the entire tech sector, when you see that company beginning to see demand destruction, what do you think? Do you think this entire sea of green is right, or do you think Apple is right? This is what I had to say about it, guys, and this is what the trading community looks like. If you're interested, check out the link in the description. It's $20 a month, and I do share every single trade and investment that I make in real time, as well as a bunch of other really cool stuff. Now, here's my comment. A very unusual sight, not one I ever thought I'd see. Everything is green except for the world's largest company. Apple is deep, deep in the red after cutting production orders for its iPhone 14 following weak demand. The market is ignoring this at its peril. They are all wrong. Apple is right. Everyone will soon follow. I am betting money on it. If I'm wrong, I will cut my losses. If I'm right, this will get very ugly very quickly. Now, I did add to my short position today, guys. I'm not going into too much detail about what I did, but I did add to my short position today. In addition to Tesla, I opened another short position in another company where I found very interesting edge, a 4% edge versus the entire market that I plan to capitalize on. Now, again, guys, if you're interested, it's $20 a month, and you get access to all of my trading activity, exclusive member-only videos, trade ideas, investment ideas, a lot of stock market analysis every single day. There's a lot more stuff here, guys, that you don't see that I covered today, including very key levels on a bunch of indices as well as a few stocks. I also share my investment ideas, including in things like Bitcoin, gold, and my long-term investment goals. I also share my weekly watch list, trading resources, including market research and market data points. And there's a lot more rooms here, guys, where members can discuss trade ideas, investment ideas, strategies, as well as news events, economic data interpretation. And there's also a Q&A section where I answer everybody's question. Again, guys, this is the best way to support me if you want to do that, and you get access to a bunch of cool stuff and an amazing, absolutely legendary community. Now, I did notice a bunch of more shenanigans that I will get into, including in Apple, but let's continue with the daily chart. Now, guys, what is interesting is that tomorrow will give us more hints into whether this is actually a bear market rally, which I believe it is, or if it's something more sustainable. We have a few key levels. One, we need to take out this descending resistance line. We've been trading within this channel now, going back really to mid-August, since we put that August high after we saw that really nasty divergence where the S&P was making higher highs while the HYG was putting in lower highs. That alerted us that this was the top, and we went short there and we made some nice profits. So we need to see this resistance line taken out. That's number one. Number two, we need to see the market rally tomorrow, not just today, right? Because after every one of these bear market rallies, we had a nasty reversal the next day. So we need to see a more sustainable rally. But very unfortunately, guys, a rally tomorrow is actually not something you want to see as a bull. So there's a conflict of interest here, right? We want to see a rally tomorrow to confirm that this is not a bear market rally, but we also don't want to see a rally tomorrow. Why? Well, because we have the PCE inflation figure coming out Friday, and we don't want to see the market going into that inflation print, which is coming out before the market open on Friday. We don't want to see the market going into that event overly optimistic. Why? Well, because the last time we were overly optimistic going into the inflation print, this happened. this massive sell-off happened because we were too optimistic going into that inflation print, and that inflation reading came out much worse than expected. Now, there are a few hints that indicate that this is a bear market rally. One of which, guys, is very interesting. Look at this. This is a descending wedge pattern. This is a bullish descending wedge pattern. As soon as we break out of it, we usually see a nice rally to the upside. Now, we had a descending wedge pattern here that I was tracking, and we did have this failed rally attempt on Monday, and I did warn that this looks very weak. Again, we had another failed rally attempt. Today, we had more steam. We picked up more steam following that news of the Bank of England. But it actually makes no sense. The market should not rally off that news at all. If anything, guys, that news pours more fire on already raging dollar index, right? That just pours more fuel onto this fire. And it makes no sense for the market to rally because the Fed is not going to pivot even if the Bank of England is. Now, I'm referring to the descending wedge for a very good reason. Look at this. After we broke out of the descending wedge, we had 4 very strong rally days, right? Very strong green days. And now compare this bear market rally to this. This is way more anemic. We had a failed rally attempt, another failed rally attempt. Finally, we had a green day, and then we just closed at the upper edge of this demand zone, closing this gap. That's all we did. Right, that's all we did, and this rally really was dragged down by that weak Apple performance. And it's just going to get worse for Apple. Now, this is Apple, and if you remember, guys, yesterday I said as soon as we take out this low, $149, Apple will see a waterfall sell-off. I'm still 100% squarely in that camp. We completely failed to retake these lows, these $150 lows. Now remember, guys, this was the lowest close we had on Apple since we put in that August high. And so we failed to take that back today. We rallied to it, and then we failed to retake it. We closed below it. And so unfortunately, this counter trend rally today in Apple just gave bears more reason to short. Now, if you are bullish on Apple, you do have some good news, because look at this enormous volume, right? A lot of green volume, a lot of buying. We opened down, we sold off, and then we reversed to the upside. So overall, this looks bullish in a vacuum. In an isolation of events, this looks bullish, right? We have a lot of buying here, and we have this morning star looking candle, which is a bullish candle. But on its own, it's not enough. This morning star bullish candle needs a follow-up candle. We need a very strong full-bodied green candle to follow up to form that morning star pattern. This is the morning star pattern, guys, where we have a sell-off, we reverse back to the upside, and then we have follow-through day, a follow-through day. So we need a follow-through day, and if we do get that, the chances that this is the bottom in Apple will be significantly higher. Personally, guys, I'm still in the more cautious camp. I don't trust this rally at all. Now let's take a look at the triple Qs. Again, we had several anemic days. This was the first really full-bodied green day that we had in the triple Qs. Now contrast this anemic rally that looks 100% like a bear flag. Now contrast this to this massive bear market rally that we had in early September. Again, a much weaker looking market. It is also worthy of note, guys, that very strong green volume does not necessarily mean that we had the bottom, right? Because that happened here and it happened here. We had this morning star candle and it failed. We had a bunch of green candles. They all failed. We had this morning star pattern here, a reversal candle, a massive rally, and then it completely failed. And that's because fundamentally a fundamental event came and it just obliterated the technicals. And we do have a fundamental event coming up. That's coming up Friday, the PCE, the Fed's preferred inflation measure, the personal consumption expenditures measure. And if it comes below expectations, this will be a low and we will have a nice rally. But if it comes above expectations, if the inflation figure comes out hotter than expected, again, I will not be surprised at all to see the market sell all the way down to the lower weekly expected move of $356. even taking out that a weekly expected move and going even lower than that. And now if it's a good number, we could see a nice rally to the upside. We break outside of this descending resistance line. We have a nice rally to the upside. We rally all the way up to the upper weekly expected move at just under $380. So both possibilities, guys, are real. So far this week, guys, both bear and bull option traders really lost money because we just doodled around the middle of the weekly expected move. We did not have any decisive moves either to the upside or to the downside, right? The middle of the weekly expected move is 367, and we just traded right around that middle ground. Really, the bears did not win, the bulls did not win, nobody won here. It is very obvious that the market is waiting for that PCE figure. And according to seasonality, guys, we do tend to have these nice counter trend rallies in the beginning of October. So if that PCE inflation figure comes out really nice, lower than expectations, if inflation comes down meaningfully, we could see a really powerful rally in the first half of October before that second leg down. Overall, guys, in the next, let's say, 4 trading weeks, I am still bearish. I still expect us to go down to $330, even possibly to $320 by the end of October. So in the medium term, I am still bearish, but it really all hinges on that PCE print, whether we get a very powerful counter trend rally or whether we get something more anemic before selling back down. Now, more good news, guys, is that the HYG has made a higher low, but I need to see the S&P 500 making lower lows as the HYG continues to make higher lows. That would create that bullish divergence signal that I always wait for to go long. If we start to see that, that will be a very good sign. And so if the market continues to make lower lows for, let's say, the next week or so, and the HYG makes higher lows, and we retrace back to the lower edge of this weekly expected move by the end of the week, that will make a nice signal to enter long. Let's take a look at the TLT. Again, really nice buying pressure in the TLT. The long-term treasuries. Again, this is following the Bank of England intervention. But still, guys, this could fizzle out really quickly depending on that inflation figure. It all depends really on that inflation print Friday. Now, let's take a look at the VIX. Above here, guys, this is the VIX, the fear index, the volatility index, and below that is the daily chart for the S&P 500. And I'll get to that in just a second, but I want to show you something very interesting. Now, this red resistance line, we've never traded above this red resistance line in any of the bear market sell-offs that we had this year. This was the first time that we had that. And this is a warning shot, a warning sign that this sell-off is completely different. This red line is Hell's Gate. We closed twice above this black line. We never closed above this black line year to date. Now we closed above it twice, yesterday and the day before. And today, guys, we looked like we wanted to explode to the upside on volatility and for the S&P to crash if it were not for that Bank of England intervention. And unfortunately, guys, when the VIX is this high, when we're talking about the VIX in the 30s, the stock market tends to trade more on news events, less so on technical. So we're getting into very tricky areas here where we're surfing really massive maverick waves. Now, the reason I added the S&P 500 on here because I wanted to show you something very interesting. The top of the VIX does not always indicate a stock market bottom. And I'll show you what I mean. Right here, guys, we had the VIX put in a high and we had the VIX put in a lower high 3 days later. Now, if we take a look at the S&P 500, this was the low that the S&P made, and the S&P 500 continued to make lower lows as the VIX was cooling down. This was a bullish divergence where the VIX was cooling down and the S&P 500 was making lower lows, and that was a bullish divergence signal. We also had the HYG making a divergence signal here. We also had the S&P 500 making a bullish divergence signal on the 2-hour chart on the PPO, and so we had a bunch of bullish divergence signals. Right now, guys, we don't have any bullish divergence signals as of yet. Another example that I want to show you is right here. Look at this, guys. We had a blow off top in the VIX right here, and we made a bottom, but not the bottom. Look at this. The VIX never retested this high. in the following several trading days, but the S&P 500 continued to make lower lows. In fact, it continued to make lower lows, and then we had another low several weeks later as the VIX made a lower high. So we were building this massive divergence in the VIX as compared to the S&P, and that resulted in this bear market rally. But this bear market rally ended up failing, and then we had another sell-off. And just look at this, guys. The VIX again made a lower high here as compared to here, even though that we had a massive sell-off and a new low. The point that I'm trying to get to is this, guys. I need to start to see the VIX cooling down while the S&P 500 continues to make lower lows, while the HYG continues to make higher lows. I'll be more confident in going long when I see more of these divergences building out. I'm not seeing any of these just yet, and that's why I'm calling a bluff on this being the bottom. I don't trust this being the bottom at all. I think we need to see at least one more flush down to make a divergence. At that point, I'll be more confident in calling this a bottom until we get that sell-off in the back half of October. I hope that makes sense, everybody. Now let's take a look at the dollar index, guys. The dollar index has this tombstone formation, right? We rallied. We had a indecision candle at the top, and then we moved down. Now, usually, guys, this is a very bearish signal, and it indicates more selling to come. So more weakness in the dollar index based purely on the candlestick pattern. Now, very unfortunately, guys, I'm going to show you why candlestick patterns on their own are not enough. Let's take a look at this. This is US oil. This is oil, and it's really that rip your face off rally back in February. Look at this. We had the exact same candlestick pattern. And then what happened next? Boom, another rally, another tombstone failure pattern. And then what happened? Let me show you what happened. Look at this. Consolidation, boom, explosion, massive blow off top. Now, this is the problem with going purely based on candlestick patterns. And if you notice, guys, on both of these tombstone patterns, we reversed all the way back down to the 9-day EMA. We did that here, and then we did that here again. On the DXY, we're still so far away from the 9-day EMA. And so again, I would be hesitant to call this the bottom in the S&P, hesitant to call this the top in the dollar. I simply don't believe it. The Bank of England now is accelerating the rate of the British pound devaluation, and this will only lead to more strength in the dollar. So even though the technicals are showing some weakness in the short term, the fundamentals dictate that the dollar will continue to strengthen. Let's take a look at the 10-year yield. Really the same thing happened here as bonds saw some buying, as long-term treasuries, the TLT saw some buying, as the HYG, the high-yield bonds, the junk bonds saw some buying. The 10-year yield cooled down significantly. But again, guys, we haven't even retraced back to the 9-day EMA. So again, I'll be very hesitant to call a top on yields here. Let's take a look at gold. Just like I mentioned yesterday, gold hates high yields. It hates a strong dollar. And so when the dollar cools down rapidly, we see this massive surge in gold. But again, I am not ready to call a bottom on gold. I'm still waiting for that bullish crossover on gold. We still haven't seen that. Now let's take a look at Tesla. Tesla continues to trade within this demand zone. And again, is this a coincidence? We closed right at the top edge of this demand zone. I don't think it's a coincidence. We're just coiling, waiting for that PCE inflation figure. And we'll see whether this happens or this happens the week following the PCE inflation figure, right? It's going to be this insane. We're going to see either a massive rally, a very sharp, rip your face off bear market rally, or we'll see a massive dump in Tesla, in the S&P, in the triple Qs, in everything. It will all depend on that PCE. And the best way to play that, guys, is to wait and see the market reaction. Don't try to predict. Nobody has a time machine. This channel is called Money Time Machine, but I don't have a time machine, and I'm not going to try and predict if the PC is going to come out hot or cold. I don't know. Even though I have that 4% edge that I talked about, I go into a lot of detail into the trade in the trading community, and that edge, that 4% edge, gives me a lot of leeway. Even if the PCE comes in below expectations and we get a rip your face off rally, that market edge still gives me some room to cut my losses early. Now let's take a look at the economic events that we have coming up. Tomorrow, guys, we'll have the initial jobless claims and the GDP revision for Q2. Right, the first reading was negative 0.6%. We'll see whether we get a revision to the upside or to the downside. A revision to the upside would, in my opinion, be actually bearish for the stock market, because it would indicate that the economy is still strong and that the Fed will probably need to raise rates even higher. Initial jobless claims. This is going to be a key number to look at, guys. We need this number to come in really high. We need to see more jobless claims accumulating, because that's what the Fed wants, and that would be a bullish signal for the market. But if we see jobs continuing to be strong, if we see jobless claims actually coming down, that would be bearish, because that would only mean that the Fed would have to do more. And so that's how I'm looking at these numbers. Tomorrow, guys, we'll also have the GDP Price Index. Unfortunately, this is a lagging indicator. It looks at Q2. And so I don't think it's going to be that much of a market mover. This is an inflation figure, but it's such a lagging figure. It looks at Q2. We're already in the last month of Q3, so I would not pay too much attention to this figure. We also have a bunch of Fed speakers, and do we love us some Fed speak, right? We have Bullard, Lane, Mester, and Daly speaking tomorrow. And on Friday, we have a lot of Fed speakers. We have the Michigan Consumer Sentiment Index. We have the Chicago PMI, and we have the personal spending and personal income figures, and the dreaded PCE. Friday is going to be overwhelming. I'm not going to lie to you. Friday is going to be an overwhelming day. So just strap in, guys. Friday is going to be absolutely insane. Now let's take a look at the fear and greed reading. Yesterday it was at 17. Today it moved up to 19 after that rally that we had today, which is typical. It is what you would expect to see. Market momentum is moving slightly up. Stock price strength continues to weaken. Breadth continues to weaken despite this rally. Put to call ratio made a new high today, a new high. Usually, guys, this is a contrarian indicator. When you see the put to call ratio shooting up, you want to be more bullish. But again, you do not want to front run that PCE, and so I would wait and see. Market volatility cooled down today following that Bank of England intervention. Safe haven demand still doodling around the same level. Really, bonds and stocks are trying to battle it out. They both have been really decimated. Junk bond demand has grown a little bit today. We saw some buying in junk bonds. We'll see whether we see a follow-up to that tomorrow or not. Now, that's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.